go. Okay, this is Red Ben Trader, and Ronan says hello as well. Ronan the Sphinx Cat always has to be part of whatever's going on. If you want to reach me on Twitter, is the easiest way to reach me. It's at Red Ben Trader. And then if you want to learn more about the execution algo I'm using, it is based on the Trade and Perform algo, which is produced by my coach. You can email Simon. It's trade, the letter N, the word perform, at gmail.com, and ask him questions about how much it costs to get the algo on your desktop. We have he does coaching, and we have a trading room where we trade futures together with a small group of consistent traders using the same ideas as I'm going to talk about today. So if that's something you're interested in, email Simon and let him know you found his room through me, and he will give you a free week in the room to kind of see if it's for you, and likely also a phone call with him if you have questions about what you saw. But that's all the marketing I'm going to be doing. So from here on out, we are just looking at a new trade setup. So again, I know that the screens are complex and busy. So realize that's okay, because while it would be nice if I didn't need every single signal, and eventually it is my version of the algo is a work in progress. I don't have Simon's opened up here, but his is a lot cleaner. I'm adding some new ideas here that I will eventually turn into something like a colored background or some other visual signal. But for now, I'm just using like the raw data. So there are more things on the chart than there should be. But for the time being, I need to kind of forward test and see if my newer ideas are working. And so I've kind of got everything showing under the hood down here. Whereas eventually, some of these things are going to get like automated, if you will. To the whole idea of the algo is it's basically interpreting the bid-ask spread, the order book, the order flow, things like I mean anything you can think of that you can use to read a footprint. That's what the algo is doing. So the algo is reading the footprint. It's giving me a readout. Letting me know when certain conditions are happening, and those conditions confirm every time a bar closes. So it's really important when we're watching this live. I was actually in calls, but covered too early. I was looking at the wrong time frame. I thought I hit my target, but now that I was looking at, no, that's too bad. I was looking at the 24 tick and took profit here. Thinking I'd already gotten past my channel, but now that I just realized just now, and then I went to set up the stream, but I just realized on the 67 tick, which is where I'm supposed to find my target, since that's where it's set up, that target was here at 80. So had I still been in calls, this is where I want to be taking some profits. Doesn't mean it has to go down. You certainly don't want to short it, but yeah, no one's perfect, and yet again, the exits are likely harder than the entries, but my target was hit. Even if I didn't get the last half of it, I got a little more than 50% of the current move, and I'm happy with that. So what was I saying? I got distracted by the price action. Yes, if once the bar closes, so like, see, this bar is closed. That orange in the background and the diamond and the arrow, the color of the bar, right? Like the purple wick, those things are gonna be valid only after that bar with all the signals closes. So now this one can be used to make decisions, but you can see this star here is on a live bar. That star is not confirmed and may not actually print when the bar prints, but once it does close, now that star is valid. But like, see how that other one, there was a star for a moment and now there's not? It's because the conditions for a star were briefly met, but the bar is still live. So with more order flow, the requirements for that star were no longer met, so it disappears. Now it could reappear again. The important thing to understand is we don't know what the algo really is going to say until the end of the bar. We actually have them flashing ahead of time as a convenience. It's something you can turn off, but it's nice once you learn how to use it to have a live warning. It's just a warning light that kind of says, hey, if you were looking for a purple bar here, it is currently met those requirements. So you may want to get ready and put your sell order down here. So, and then when the bar closes, you would get short. Now, like I said, if your rule was I need the purple bar to print, then right there when it prints, you need to look and say, is it purple? And if it is, then you leave the trade alone. And if it's not, you cancel it, right? That's not actually a trade entry here, but I'm just saying that's how the actual execution of every trade signal works. I've had a lot of people asking questions about like, oh, there's so many signals and there's so many, like you really don't need to know a lot about anything to actually use the algo. You just need to play with it enough and work with it and study it enough that you know how it works and you start to get confident with how the setups play out so that you know obviously you'll never know which setups will work and which setups will not work. And past performance is not indicative of future results, all that stuff, right? Disclaimer, I'm not, licensed to tell you what to do. But when it comes to what I do, I've gotten so familiar with how the Renko bars form, and what the algo does in certain situations that it's become so much easier for me to click the button and to stick with the trade through my plan rather than having to constantly look at this and wonder like, oh, was that enough volume? And like, I don't know if my stop's in the right place. Look, you have all these other variables that you don't know which ones to pay attention to with the footprint. But once I learned that like I could just understand like some simple sequences of signals and I can trust that those conditions actually occurred on the footprint even if I'm not watching it. Once I got to that point, having the algo like changed how I traded, because rather than having to constantly ask myself, is this a good trade or should I do this and should I do that? It's just see the setup, take the setup, follow what the plan for the setup is. It becomes very cookbook, and that is a good thing for my emotional control, because when I wasn't using the algo, I was a mess in every trade. It didn't matter if it was winning or losing. Like I couldn't if I was in a winning trade, I was constantly thinking that I'm going to give it all back and the market's going to steal it and all this, the really unhealthy thought patterns. Whereas now it's like, I can say, I know that when I see, this bar and when that bar occurs in this environment and it's got these signals on it, most of the time I'm going to get 10 to 15 points. And I don't know if this time it will or not, but I know that that's what I've seen over and over and over again. And like I said, even though past performance isn't indicative of future results, it's all I got. So that's what builds my confidence is like, okay, I've seen this exact combo of signals occurring on one bar during a bullish trend where I've got a star down. Sorry, you can't see that. A star down, and then it's immediately followed by an X or a diamond up. In this case, you actually had both. And if it's bullish, I know that's consistently good. And if I doubted myself while I was in the trade, I'm like, oh, I don't know how much I should hold this, and all I have to do is write down like, what's the name of the pattern that I gave it. Go back to my journal, look at and see what those conditions are, because they're all the patterns have rules for what you have to do, what you need to have it be valid, and then just go back and look at every other scenario I can find where that exact pattern came from, right? And then you see, what does it usually do? Does it go 2 bars? Does it go 4 bars? Does it barely ever work, right? And then once you've gotten that drilled into your head, rather than being worried about is this one going to be the one that stops or one of the ones that hit my target, you're literally the only thing I worry about when I'm trading realistically is am I going to get the opportunity to put my my machine to work. Like that's where I spend a lot of my like mental time is how can I identify the conditions where I want to implement these trades. Once the trade signals, there's not, I mean, I might be nervous about whether or not it's going to work or not, but once I've hit the button, as long as I know everything, the conditions are true and they're accurate, like that worrying is not supposed to interfere with what I do. It's not going to change the plan for how to implement the trade setup because I know what usually happens when I see that signal. And so as long as I don't get in the way of that process, things work out. It's a lot easier to work your system because I hope that makes sense. It's just it's amazing how you can have something that works really often, really well, 60%, 70% win rate, and has the potential of paying out 1-to-1 plus RR on a regular basis. And most of us still struggle to execute it correctly because we get in the way of the system. We know the system's supposed to work. We know how it's supposed to work. We just can't pull ourselves together to put the risk on the table, put the stop where it belongs based on systematic backtesting and other whatever else you use to make decisions, and then leave the damn target alone rather than constantly micromanaging the trade. That is what's hard about trading, in my personal opinion. And I find the algo, like, I'm not going to say it removes that problem, but it makes that problem a heck of a lot less frustrating. So I'm going to talk about a new setup that is, it is complicated. Stream, hold on, I'm getting, I hope I didn't just lose you guys. Let me just make sure I'm good. Hold on real quick, you guys. Did I get, just want to make sure I'm live. If someone can just let me know, that would work too, in the chat box. But I think I'm good. It looks okay. All right. Yeah, for a second there it said it was disconnecting, so my apologies. I think we're good. I don't know. It says I've only been live for 14 seconds. I might be wrong. Yeah, if someone could tell me. Sometimes I've got internet issues and I don't want to keep going not knowing whether or not you guys can actually access this, and I'm afraid that it might have dropped out. Because like I said, that's happened before. I'm going to have to load this video, you guys, unless someone wants to tell me. So, like, if I don't have internet, then it doesn't matter because you guys are already disconnected. But if I am still connected and it's just slowed down by the video or the stream, then my apologies. But I'm having trouble loading this, which tells me I might not be online. Oh, I think I might be okay. Yeah, it looks like I'm just delayed. So, okay, I think I'm fine. So, yes, the newer setup that I'm working on, let me just make sure no one mentioned anything. Yeah, there's a chat box, you guys, in here, rather than sending me stuff on Twitter. Like, don't DM me on Twitter. Like, when I'm doing these, just please put stuff in the chat box so that I can get it right away. Because I don't have, like, alerts set to tell me that stuff is going on Twitter. So, the idea with this trade, like I said, is that you have to sequence through a process of signals. Wow, sorry, bad timing there. Hold on. That one's really close. I live next to an Air Force base, and at lunchtime they fly the fighter planes, and I always time this horribly. So my apologies. It's 11:57. Yeah, their route literally goes right over my house almost every day at lunch. So, all right. Thankfully, they're very fast, but they are also very loud. They'll occasionally set off car alarms if they do the supersonic or whatever speed. So it can rumble pretty bad. And my apologies if you guys are on headphones. they occasionally do them at night as well, but we get forewarning before that happens. So, yeah, welcome to Vegas. Wow, he's circling my house. Okay, hold on. He's got to pass one more time, I guess. Sorry, you guys. My apologies for all that. Okay, there we go. So, right, the setup is complex, and it requires a process of filtering. So, and you have to do these things in the correct order. Otherwise, it will not set up correctly. So that's what's very difficult about this, in my opinion, is that you have to observe to see that certain things are happening on multiple time frames, but once you know that the opportunity's there, like from the higher time frame, basically, is going to be okay. Let me slow down here. So the basic idea works on any time frame, okay, but a big part of filtering whether or not you want to take a trade or not has to do with what your expectancy is for that trade. How far do you think it might go when you're right? Because we can identify very quickly with a single time frame where our risk should be, but we can't always accurately identify where our target should be from a single time frame. Oftentimes, the best way to determine your target is by using time frames above the ones that you're trading on. So for instance, on the Renko charts, I take a lot of my trades on NQ on the 15 tick that get triggered, and then some of them are on the 24 tick. But the majority, when it's this slow and I can process this movement without any trouble, like right now you can see how slow they're building these blocks. The bricks are just like, yeah, they're like turtle slow. They're not even really moving. Then I'll easily go down to the 15 tick, and if they trigger here, I'll have no trouble getting my order in to the order book. And I would prefer to have a smaller risk. And if they set up on the 15 tick, I can put my risk underneath a swing low or above a swing high for a short, and on that same time frame. And then, but like I said, the hard part is where do we target, and then when do we execute? Not because on this small time frame. For instance, like I know that the stars are technically aggressive order flow. It's aggressive order flow on the sell side. So if I see that, I know that there's an aggressive trader there pushing really hard in that direction. But the star alone, for instance, is not enough to tell me that I want to be short. I would need to know, in addition, that, for instance, the location, there was a reason that the market might turn here, for instance, and then I need evidence that not only might it turn here, but that the momentum of the market is suggesting that that turn has already started. Because the thing with reversals, and this is the case actually on all time frames. So if you haven't thought this through, it might kind of blow your mind, because it's actually the fractal nature of momentum of the markets in general is really fascinating. But momentum in particular is completely fractal. So if you find a trend, let's say on a 15 tick, that uptrend, momentum wise, is going to look exactly the same. That wave is going to look exactly the same as an up thrust, or whatever you want to call it, with momentum on a higher time frame. The only real difference is how long each wave is, how much range. Remember, because Renko is really range. They're bars that print based on range. So you can count the number of up blocks in a row, and it can tell you what the range of that momentum push was. So that range in price is going to be dependent on the time frame that you're looking at. Hopefully that makes sense. But the beautiful thing about Renko is, because it is fractal, and because they print based on ranges, when I see, for instance, 2 bars in a row here, Well, I could measure and say, okay, this bar's low is 13,374.75, and this bar's high is 13,386.25, right? So it's just a little bit more than 10 points. Let's say those two bars together is did I do that right? Is that right? 374 to 386. So yeah, 12 some point, 12 points and change, right? If but like I said, the momentum of it, if I found a very similar situation on a higher time frame, what I'm going to see is I'll often get the one bar follow through, but that one bar will be significantly bigger, right? So like, let me just find. So when I say momentum, if you think about this, well here, let me finish my thought and then I'll show you. But let's say we said that there was bullish momentum. I mean, you could do either way, but let's find a place where we have clear bullish momentum. So here, right? So aggressive trader on the bull side. So, and then all the momentum indicators are green or rising. And if you look at the bottom here on the 24 tick, the low is like 26. And then if you, like I said, if you do that bar and then plus another one, that one's going to be 48.25. So you're now more than the range has increased, right? It's more than 12 points. And then if we did the exact same thing here on the 67 tick, and I found something similar like this, right, where everything is I guess this one's rising. Yeah, it's still green, but this one is low of, let's say, 310.75 and a high of like 3.372. So this one is almost 60 points, right? So like 62 or something like that points. So the signals are very similar, and the way they set up is the same, but the amount of price movement that's required to bring about that signal to actually trigger it, you have to get a lot more price movement. But like I said, because it's fractal, if you know what it looks like, if you know what a setup looks like on the 15 tick, and you know that you can put your stop, for instance, like under this, and you know if you enter here that you're usually going to get 2 blocks or more, so you could put your target here and get hit 70% of the time or whatever, pretty consistently, if not more. Well, if you see that same exact setup on a higher time frame, the numbers will be different, but it'll look the same. You'll still put your stop underneath the low, and you'll still target whatever it is that you usually get. If it's 2 bars, it's 2 bars. It's not 12 points. It's 2 Renko bars, right? So in here, 2 Renko bars, like I said, isn't 12 points. It's more like 62 points. So the that fractal relationship means that whatever works on the smaller time frame on a regular basis, if you can find that same thing on the higher time frame, usually if it works on the smaller time frame, it'll probably work on the higher time frame. The one caveat, like I said before, like I mentioned before, is if you go to a higher time frame than you're looking and there is resistance or support nearby, the expectancy of your move may be limited. So for instance, if just to find a real simple example, if I look here where I have this star on the 67 tick, and that star is all the way up touching this channel up here. Actually, this one's better because it's above the channel. So look, this star way up here above the blue line in the downward direction is a sign of someone really aggressive pushing hard, right? And so on this time frame, that occurs at 88.25 is when it closes. And like I said, the signal isn't valid really till it closes. So 88.25 occurs right here when it drops on this blue one. And so by the time we get here, on the higher time frame, all I have is a star. I don't know that it's going lower. It's just going to show up in back in time. It's going to show up early, but it's not actually that hasn't happened yet, right? Because if you look at the price of that, it's 71.50, and we haven't reached that yet. So it's just when you're going in reverse on a higher time frame, you have to think about the fact that if it hasn't closed yet, if the bar hasn't closed yet, so anything past this, you don't actually know how it's going to close in real time, right? So at this point, what we would say is, well, on a higher time frame, I know these stars usually result in at least 2 bars of downside pressure. It may not happen immediately, but usually it does. And so then, when I think about the fact that a 67 tick chart requires like 60 points to move down 2 bars, right? And then if I think about where this top was, and I'm like, okay, well, it's already moved down. Let's see, what is that? Like 100 points or something like that, almost, right? No, not 100. Wait, that's not right. Is it? Is it? Let's see, 50 points or so in this one. So the next bar would be, let's say, 12 points, and that is a typical short target or long target price range for the 15 tick, right? The 2 bar length is usually about 12 ticks. So, or 12 points. So what that means is that I may get a long setup to trigger down here. Like, let's say this, for instance, right? And even though there are times where this blue, 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 blue with purple, and then right after that, a big volume shift, the green going higher, and especially with one of these arrows, those are all really good signals. Like, it's an indication that someone is trying to protect this low. They are volume and sellers are running out of energy. All of that is still true, but the problem is on the higher time frame, we have a really, really big seller sitting literally right here at 84. And so if you look here, that is right there where that red line is, or the arrow's pointing now. That's where the seller is sitting. And you can see that if I got in at 79, let's say, if I executed at 79, I'm not going to get 12 additional points. I'm not even going to get 10 additional points, which means that if I took this long, even if that's a long that works really often, it working just means it goes to resistance. Well, on a higher time frame, resistance is only 10 points away. So guess what happens most of the time when we hit that area? Now, maybe not this time, but usually you're going to get some kind of a reaction, right? Now, sometimes it's just going to rip right through it and go to the next one, right? But hopefully the concept makes sense that this move might be very common when this pattern is here. And it doesn't mean it's not going to happen, but the fact that we know that the higher time frame has resistance right here on the higher time frame, when this starts turning blue, the higher time frame is getting aggressive. We should know that we shouldn't really expect that buyers take us any higher than this swing high. So now, is it good enough to take a trade here? I mean, you'd risk at 68, you'd get in at 78, and you're targeting almost 98. Like, that's almost a 2-to-1. That's almost a 2-to-1 move. So it's not wrong, but just realize that when it works perfectly, that's your expectation. And once you hit this, because the higher time frame is bearish, basically, we shouldn't really assume that it's going to go any higher if we believe it's bearish. And what usually happens is they either reverse it because it's bearish on the higher time frame, or they sweep liquidity, right? Where is liquidity? It's wherever people put their stops on like any time frame, right? So for instance, if you were a short targeting this low and you saw orange bar followed by triangle down and you thought it was bearish, which, it's totally, I see it. This is your entry and your stop is here, right? So and then where's your target? Down here, right? So it's good risk reward if you have reason to believe you're long. I'm going to show you why we don't need to take those trades anymore, and why I would know not to take it. But I can see if you thought it was bearish why that might work, but in this case it doesn't, because they go and get liquidity up here, and then they reclaim it. So this one is the clear liquidity grab. Look how everybody gets short here. Orange bar, triangle down, purple bar, and then they come up, they steal liquidity, right? And then orange bar, triangle down, aggressive, right? Star, Now they can roll it. And that is normal. That is just the way markets work. So if that's frustrating to you, then the fact that you get your stop taken, then you just have to remember that like that there's opportunity there, because we're not the only ones who put our stop above swing highs and swing lows. And if you have a clear vision of what the higher time frame should be doing here based on your analysis, like if you say, look, I know that star triangle down usually results in reaching at least the middle of the channel, if not the opposite side of the channel. And so if I can get good risk reward on this short, this is the location I want to be getting it. But I don't want to have to put my stop way up at 13,440, because getting in at 13,388 and putting my stop at 13,440 with futures is it's painful when you're wrong, especially since sometimes you're wrong only to see it roll over. Like if you took this one, this star, you would have gotten paid. But let's say it didn't even get to the midpoint, and then it came up and it swept up liquidity only to go and trigger again, and then eventually go lower. Like that whole process is what produces for a lot of people like tilt and like emotional trading and stuff like that, is when they were right that the market was in a position that it could reverse, but their timing was off. And so if they took this one and they thought, it's going to the moon, or going to zero, I'm not going to take any profits, even though you really should be taking profits here, because a lot of times that's your target if you're trading counter trend. But then when it comes up and it takes your 40-point stop and you're like, oh my God, I just lost $800 per contract, I don't want to do that again. And then you skip this one and you don't get paid, right? And like I said, I've made that mistake. Everyone's made that mistake. That is human. But there's a way to solve that. You're not going to know which ones work and which ones don't. Unfortunately, that like utopia does not exist. There's not a way to be 100% sure that this setup here is not going to reach the other side of the channel. But I've found something, while it might not give me 100% results, it's at least going to tell me that on this time frame, is it a good idea to take that directional move and will it work more often than it won't? And therefore, by knowing which time frames are triggering for the swings, like what I call a swing is not just like a little scalp, but like a move beyond a swing low or swing high. So not like overnight trading necessarily, but like more than a scalp, we call a swing. So if you're trying to catch, like if you don't care about this, but you want to catch that, right? If this is what you want, is this move, right? Then you just need to know what time frame to trade it on, in my opinion. Because here, that is beautiful, right? You can make a lot of money with that little move. On this one, on the higher time frame, that move made a lot of people very upset, because like I said, if they put their stop above and they didn't take profits on that big move, which I saw as a swing, but someone on this time frame would be like, I have my target here and it didn't get reached, right? And so the reversal hasn't happened yet. But if all you're looking at is this time frame, you could do that. You might not take profits, realizing that on the smaller time frame, you actually got triggered into a swing short. Like this was a big trade on the 15 tick, especially considering what was going on up there. That's a big move. And so knowing that can help you decide, should I wait for my big target down here, or should I be out of most of my contracts at the midpoint and then, maybe let one or like 1/3, let's say, of them ride in case I happen to go for the really big one. Whereas when it sets up here, the setup here is relatively similar. I'm going to show it to you. It's relatively similar here to short it, even here. And then the swing is pretty much the same. See that? This move is almost worked, hits your target, it hits your primary target. When this one didn't, is mega high. like really high. And what that means is that once you have this setup figured out, and like I said, it did take me a while because it's complicated, you can actually filter it further. If you are a really risk averse person and you're just like, man, I hate taking losses. If I take 2 losses in a day, I tilt. I just can't handle losses, right? The best thing to do is to accept that you're going to skip this move here and you're only going to take the entry after the liquidity grab when it triggers a second time. And all that's going to do is it's going to mean that your entry is probably not as good. So rather than entering here at 72, you're maybe entering at, somewhere in here. You'd enter still on the smaller time frame, but I'd enter. Nope, it'd be above that. It would be at least. When does the star happen? 72. It would be 72 still. So the entry's the same, but rather than having a target of what was this 38, rather than having your target here, you'd have your target at the channel low, which is 304 304.10, let's say. So you'd get out here. You'd be out with at your target, right, of the majority. And then I mean, if you want to hold one in case it crashes, sure, but that's where the target says to put it. And then you get triggered in here for a reversal, believe it or not. And you could literally ride the whole thing another bit if you wanted to. So so that's what the potential of this setup is really strong. It can identify spots where you want to reverse. It can identify spots where you want to take more risk or hold for a bigger target. And it can also help me determine which ones to avoid versus which ones to take just by looking at multiple different time frames and making sure that I have direction aligned so that I'm not, like I showed before, we don't want to be buying into higher time frame resistance. Damn, look at that move. I definitely should have held those calls. Wow, back to high day. We don't want to be buying into higher time frame resistance when the higher time frame has the potential to be bearish, and we don't want to be selling into support when the higher time frame has the potential to be bullish. So how do you know when to do all this? What is the setup actually looking at, and how do you do it, right? I'm going to talk about that in just a second. Let me just go check on my cat and make sure he's okay, because suddenly he is gone and I thought I heard some meowing. So give me 1 minute. I'll be right back, and let me just check on him, and I'm going to show you how this setup is built and how to run it. And believe it or not, a lot of these things you can build yourself, but you won't be able to get the execution that you do with the algo. But you can at least get a feel for where the filtering device. So I will be right back, you guys. Give me a second. Okay, he just found a bird in the yard, and we're all good. um, wow, I definitely should have held those calls. That was a mistake. We can go over why I made the decision I did. It unfortunately had to do with the fact that I didn't think I could really watch the market, but they were just calls, so I should have held them. If it was futures, that's one thing, but I could have held the calls, or at least one of them. So it was, yeah, just got a little bit anxious on my part. But now that I've seen it work once again, I just need to like drill into my head that this is a setup that I can trust. So how does this setup work? What are the components, and then what is the sequence? Because like I said, and I apologize ahead of time, this is complicated. I'm primarily doing this for my own future viewing in case I get confused again, and I want to show what worked for me. And like, I mean, I had a good day, like just basically just doing this in all of my accounts. The bottom one I was trying MCL, the micro CLs to see if it works there too, and it does. It just, I didn't make very much because I got out of it. But I mean, the setup clearly it seems to be working currently, right? So what are the components? The first thing like I said, it is a little complicated. Again, apologies. The first thing you need is you need to understand what divergence looks like. And there are two different kinds of divergences, and we're going to use them in two different situations. So divergence is, then there's bearish and bullish for both of them. So divergence is basically when the price action, highs and lows of the price action do not match the highs and lows or the trend of an indicator. And there are two indicators we're going to watch for divergence in. The primary one is called the volume zone oscillator. This is a free Sierra chart indicator that you can get if you have Sierra chart, or just Google it or whatever if you want to figure out how to code it yourself into whatever you're using. It's not complicated. It's basically just looking at how powerful, how aggressive volume is. An example of bearish divergence would be putting in a high here, this high here above the red line, and then if price then makes a higher high, there it is, and turns around after that, putting at least one Renko bar down, if we then make a lower high like this, that is what we call natural bearish divergence. So the VZO would be dropping. Again, we need a down bar for it to confirm, but if we get the down bar, we'll see that VZO could drop and the price would make a higher high rather than a lower high. But like I said, for that to occur, the first thing you need is you first of all need this bar to close to know where the indicators actually will be, because once it's closed, it doesn't move. But as you can see, when it's live, it's moving. So we need at least one down bar to confirm. And then you obviously need a previous high to compare it to. And that previous high needs to be both on the indicator and on price action. The very best natural divergences will occur when there's either very low volume or lower than previous spikes, or at capitulation periods where there's a ton of volume compared to the last spike, and like what is it called, a parabolic high kind of looking thing. Otherwise, you want it to kind of be like a failed attempt with very low volume. And then also the very best ones will be not like they will look like. Let me find one. It's easier if I just show you. And there's another kind too. But like I say, if we look down here, I'm gonna find. So this is the less good divergence, where you have a touch, a pullback, another touch, and then a push, right? So right here, this is the weaker. Oh, wrong one. This is the weaker one, right? So it is making lower highs, and this is making higher highs, right? But what you're going to see is this peak here is less preferable then something like, well, this one's too deep, but something a little bit rounder and deeper. Let me find one. Let me find a bearish one. There are some bullish ones here, but let me find a. This one's good. So see how this is like a peak, and then this one kind of rounded out, and it was unable to breach like a resistance. Sometimes they look like head and shoulders as well, but this is a very good example of bearish natural divergence, and it's at the midpoint, which will only work if you're in a bear trend. If you're in a bull trend looking for a reversal, they need to be they need to at least have the first spike up high, and then the second one, it's great if it's low. So here we go. This is the good one. High, 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 and then you see how this is like super, super overbought, if you will, right? And then so here you might not be sure because they're awfully close. This one's kind of spiky, right? But once it rolls over like this, that's what you want them to look like. Like if you don't know for sure if this is divergence or if it's divergence you want, once you get that breakdown, like like it's not too late. Sometimes it happens right without the second little peak, and it'll just be a roll. That's what I'm looking for. It'll be at the top of a bull trend. Okay, so this one, peak, and then see how it kind of rolls away. Sorry, it's got the orange on it, but that's a good one where it kind of rolls out here is what you want. Not like a big, here, this is great. It's like it's literally running out of gas. That's what you want to see. Not just like a test above, but like a true fail. Like I want to see them like not just try, but really push and then get nothing out of it. And then let me find some bull ones. The bull ones are often easier to see. So here's a good one. This is a good one. So see, that made a lower low, but the indicator made a higher low. And in this case, I like it a lot because one of them is rounded and one of them is pointy. That's really great. And then plus, one of them is trying to get into the oversold range, but it can't get there. And then this one, the location of it, in other words, is very good. This green here, it basically shows me what the neutral range is. So it doesn't mean to sell it when it gets lower and buy it. Like you wouldn't just want to buy it because it's up here. But once they've pushed that high, it's the likelihood that it's a trend is increased. And so you're going to need to, you can't just short this drop, right? You can't just, once they get up here outside of the green area, these are not going to work unless there's divergence. That's really the key. So you're going to need to get a divergent high like that. See how it's going lower? And then we need to drop out of the overbought range to be confident. Because otherwise, you could short this and put your stop here and get hit potentially right when they test it. So you don't necessarily just want to take the very first, there's no rush is what I'm trying to say. It's not just sell the first Renko bar. What I want is a trade and perform entry. So for instance, star followed by triangle down would be preferable. So otherwise just a triangle down in general. Now here, see, we didn't even get a triangle down. There's no red triangles here. And even though there was divergence, clearly, and it fell down, you could have shorted the star, and that would have been pretty aggressive. But what you're going to see is it went deep into the negative territory. And now we have to watch and see if they have continuation. Because if they get back above this 50 line and they hold it, it's over. So you have to watch right here. And then you see that if you were short here, you might have gotten taken out here and here, right? And that'd be pretty frustrating if you took a stop twice and then it works. And so like I said, the key here is to not worry about whether or not, don't be in a rush to take the first aggressive signal when I see the divergence. There's other ways to improve this other than just using the divergence here. But when I get the triangle down after the divergence, as long as I'm getting it following some sort of retrace, see how it kind of retraced up into the 50 and then it rejected, and that's when I got the red triangle. That's what I want. I want to see the divergence, get a retrace. It doesn't have to suck liquidity, but if it does, it's great. And then basically get like a trap back in trade. So this, where that arrow is the aggressive entry, and then this is the more conservative entry, and then you're going to get the swing if you've lined everything else up. Okay, so that's the reversal. That's the natural divergence, right? Let me see if I can find one more bull one just to demonstrate. So we need a down move, and then we need a low, and then we need a lower low on price, but a higher low on the indicator. See, this one made a lower low, so now we'd still wait, right? That's a lower low, not divergent. Doesn't mean that can't be the low. It's just that this specific setup for the reversal is not yet. Okay, there. Lower low, higher low. This one's clearly oversold. It came all the way up, came all the way back down. If it was still bearish, it would have easily dropped into the oversold range again, because during bearish conditions, most of the traders are aggressive to the short side, so they can push it down there with no trouble. When it's balanced, they don't spend very much time down there at all. Well, they get to a lower low, and volume has not been that aggressive to the sell side, and they create a divergent low. And like I said, could you take the trap back in? Totally. This is absolutely a valid entry. And if you weren't sure, you'd wait for the triangle up. Now, will it work every single time? Not with just divergence, right? And if you want to, like I said, if you want to further filter, if you're like trading against trend day up, if you're trading against a trend day, so you're looking for the low of the day on a trend day down, for instance, rather than just taking the first triangle after the divergence like this, what you would want is you would see the divergence, you would see them produce the triangle, and you'd say, okay, I've now got divergence at the low. If this low can hold or be defended, then stars can be taken to the upside. But to make this really easy, rather than having to think through all that, all you really have to do is look at the higher time frame and determine whether or not you're bearish or bullish. You can see here, as soon as we had the star triangle down, and then again star triangle down, star triangle down, those are all sell signals. And it's going to be really tough to buy to get the market to like bounce. Every time we get one of those, it's going to be harder to get these rips here. Is it possible? Yes, it's possible, but it's usually just to come up and suck liquidity, and then they attack again. So if you want to pick a time not to buy, stop buying when the higher time frame says sell, and then accept that you might miss the bottom, but that once you see the bottom, you'll know it's there, because on the higher time frame it'll set up bullish, and then you'll have plenty of opportunities to come over here, make sure you've had divergence, and look higher. Okay, so here we had the first divergence here, right? That was divergent, gave us a triangle up, it totally failed, right? Then we got back down here, we got a star, see that? And that one also, lower low, higher low. And see how this one kind of gradually went around? Now, it's not technically bullish unless we can get the VZO above zero line, and it technically has to defend the zero line as well. So if you want to be a really conservative trader and you don't want to take a lot of stops, you're not aggressive trying to get these reversals, you just wait until the VZO holds above the zero line. So here, it couldn't get above the zero line, and so you would just skip this one. Of course, you could also know that just by looking at the higher time frame. And then here, it starts to go. It can't even give you triangle up, but if you can see, you didn't get over the zero line. So if you then got this star and you're like, wow, it's divergence, I got a star up, you'd ask yourself, well, what are the chances that I get above the zero line now? And you can see we've already tested it twice. We made a higher low, and we're coming at it again. Most likely, it has room to move, right? And when you get the triangle up, you're clearly above the zero line. So if you did wait, you could say right here, okay, now if I get any wick to the downside, I'm gonna buy, and you'd end up buying this wick. And you can see it's holding above the zero line. So now pullbacks could even be bought. I don't know if I'll get one, but and then on the higher time frame at 38, which is right here, you get green bar, speed trap, and it's like, okay, and it's at the bottom of the channel. So you'd say, okay, I know they're trying to reverse it here, and that's pretty obvious on this time frame too. But the important thing is to say, if I get a triangle up, like another 60 points higher or so on this time frame, there's a relatively good chance that pullbacks on this higher time frame or traps in the higher time frame. Hidden divergence is kind of the opposite of natural divergence. We want a higher low on price. Uh-oh, did I lose the stream? Hopefully not. I keep losing internet, sorry. We've got a higher low on price, but a lower low on the indicator. And so it's still divergent, but it's divergent in the opposite way. You're making higher, you're trending up on price, but the indicator is going lower or not trending up, which basically means that it's got more room to the direction of the trend now. It's kind of corrected itself, and now it has some more room to lift. So the likelihood that a bullish trend with a low VZO, the likelihood of it rising quite a bit is way higher because now it's got more room to move. We just need that higher time frame, that price trend to continue. In other words, as long as this low isn't taken out here, if we can put in a lower low or an equal low on the indicator, particularly if we can't close and hold below the zero line like this, where it kind of tries to get there, but it lifts off of that. All right, this one is really good. You could say, well, hey, if I get a signal to go long, I might as well join the trend now because I know that even though sellers tried to push it and they got some aggressive volume, which is what this is telling us, this big push down, they couldn't overtake the buyers. They couldn't get through the zero line. And even though they made a lower low, buyers still made higher lows. So the trend is intact, and we want to buy and join the trend. And so you get that. Okay, and so that's an easy way to do it with just that indicator. It works better if you have a confirmation like a purple bar followed by a bullish bar or a star or a triangle up on the algo. You would get confirmation that it is a good aggressive time to go, or a pink bar would be a really good time too when you have that divergence. But eventually you're going to get to the point where it gets into the overbought, and then if it gives you a divergent high and then rolls out of the overbought, there's a chance that you can roll over on that time frame. And then what do you know, on the higher time frame, we get a test of the upper channel and a star down. And as we saw in all these other spots, and especially on a lower high, a star down, our expectation should be lower. It may not be immediate, but more of our sells are going to start working, and more of our buys on the smaller time frame are going to start failing. So if you want a time to skip longs, do it now. Stop taking the longs. Well, here you can see we had a low. We took that low out, and it made a lower high and a lower low on the smaller time frame as well. So really, if you wanted to be aggressive and you saw this head and shoulders, you could get in at this purple bar for sure. That's totally fine, especially since you actually had divergence here, and then you're rolling down. So I don't mind that at all. The Head and Shoulders is good. In this exact scenario, it's perfect because the higher time frame is also confirming that it's potentially bearish, and it came to a location that you'd expect sellers to defend, which is the top of the channel or previous volume. So that dotted line, that's where the volume was on this aggressive trade. That's where most of the volume was. They came back up. They couldn't get to this volume, and they put in another aggressive trader. There's a good chance that this guy and this guy is the same trader because he's trading in the same area. Most of his volume was in the wick. Well, we came right up to that wick zone around that volume and we defended, right? So that might be this, like, look at what they did when they got there, right? They couldn't get any volume above that, and they tried, but just got wicks up there and no VPOCs, and then it reversed, right? If I take this and extend it, no bullish VPOCs, the yellow line, and the dash at every bar, there was no VPOCs up there, and definitely none on a bullish bar. So they have not been able to put any volume, buy volume, into that wick on the higher time frame. And the lower time frame now shows volume divergence, bearish volume divergence, meaning that even though they've been pushing really hard and getting a lot out of it, all of a sudden that volume is no longer so aggressive, and yet price is just hanging out. Well, now it's probably your shorts that will start working. So like that is probably a good short. So like just because you see it, the divergence way back here, doesn't mean that you have to short this first bearish bar, right? You can short this triangle, you can short this triangle, and it still works because the higher time frame is bearish. And then you see it follows a triangle down, and we know in most cases that's going to take us where? To the opposite side of the channel. So now our target's 313. And so if we get another one, and as long as we haven't had divergence, we can start to continue to look for shorts. Okay, so here, this is a trap back in, star, traded behind an apex, closed below it, triangle down. Star triangle down by itself is good. A trap on a star is even better. And now this one, they needed one more try. And like I said, this is just the way trading goes. Sometimes it's going to need more than one. Oh, wow. So this one would have gotten your risk off. This one definitely got 10 points, but this one did not work. Now, take a look. Was there divergence? Was there divergence? Let's take a close look and see. Okay, so this low is lower than that low, right? So higher low on price, lower low. That was your signal. That was tricky. Lower low on the indicator, low, higher low on price. So right here, and purple bar followed by a divergent dot is usually a good trade anyway. And then pink is usually bullish as well. So there were lots of reasons without this technique to know that you might get some kind of a pullback. But again, the higher time frame did say bearish, but where did it say bearish from? It said bearish from where this guy was selling, right? So this one right away makes a ton of sense, right here. This is fine, in my opinion. Right there where everyone's selling, you carry on with them, you get paid, right? No question. And what this is, the higher time frame says is moving higher will probably result, if we move higher, it'll probably set up short, is what it's basically telling us, unless we start to see divergence. And with the hidden divergence like this, where we get a higher low on price, but a lower low on the indicator here, that is only relevant in the direction of the trend on that time frame. Well, you can see on this time frame, we're making a high, a low, a higher high, a higher low. It's bullish on this time frame. So I wasn't looking for it just then, but I actually caught this trade because in real life I was watching for that, but just in the review I missed it because I wasn't paying attention to this pink bar. So they gave you plenty of warning that there was something bullish going on here. But what we have to remember is the higher time frame. Once we get back up to 72, there's a seller waiting there. So that has to be our target, and you would only be able to long if you thought that you could get good risk reward. Here I did have good risk reward because I could get it at 52 and put my stop underneath this low at like 42. So it's like a 10-point stop, and I might get to 72, right? Which is like a 20-point gain. So I thought it was a good long, even though the higher time frame. This is one of the situations where I made an excuse and did a long, even though the higher time frame said short. But like I said, if you didn't see that, you'd get stuck shorting, and then you'd get your risk off here. So you get paid, you get a lower low, but then it does do it again because your seller on the higher time frame is actually here in the wick of that star bar, and they can easily retrace the triangle. It should be hard to retrace the wick on the star when it's a lower high. See this lower high here makes this star harder to retrace, and this lower high makes this harder to retrace. And that's why it's such a good, that's one of the reasons it's such a good entry, is because it's defended. It's expected to be defended. So, where was I? It's this one, right? No. Pink. Did I go too far? Yes. Okay, so once it rises up there, we get a star on the downside, and that's bearish, right? And you're going to get choppy in the middle. I know where the middle is on mine too because I've got a gray line, and so this line is there on mine as well. But then this star is very powerful because it's touching up here and it's not touching the gray. So he uses the blue for that purpose. I am using something slightly different because I've just watched the blue for so long that I know where it is, basically. And I've got the midpoint, the gray there, to know where not to trust. So like this star is beyond the gray. See how the gray line is here, right? The wick goes beyond the wick, needs to be above the gray. The open basically needs to be above the gray. Otherwise, I don't have any expectancy to my target. So I would probably skip that trade, and I definitely wouldn't take this unless I thought that we had zero bullish momentum whatsoever. But here I can see that we're making, bullish hidden divergence, and we've got higher highs and higher lows. So there is bullish tendencies on this time frame, even though the higher time frame is bearish. So that's super clear. So once you get here, and then even more so, okay, ish points, right? And that's normal, even when it's bearish here, because we have not run into that seller, like I said, is at 72, right? It's marked off here for a reason. And so it rises, but then what does it do? It approaches 72, and it gives us a star down. That star down does not have the wick touching the gray line, so I do care about that on this time frame, and I do see that as a potential reversal signal, unless there is extreme momentum on the time frame I'm looking at. So what does extreme momentum look like? A very easy way to see it, it's a little complicated to build it, but it's an easy way to see it, is to use the Williams percent R. The Williams percent R is a very simple momentum indicator with a range of 0 to negative 100, and it's this yellow line here. And all it does is it takes the close of the bar and it compares it to the range of the high to the low. So it's saying, and so it's just looking at like momentum. And what's beautiful about the percent R is that the close of the Renko bar is always at the high or the low. It's never in the middle. So, that means that the percent R on the Renko chart is taking into consideration the entire range of that bar, right? It will always be on either the high or the low. It will never be in the middle. So it ends up giving you a very clear view. Oh, hi there, Ronan. This is not what happens. This, like bar, 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 that is significant. It's a sign of people capitulating, of buyers rushing in. It's momentum. And so once the momentum is, you want to know that as soon as possible, right? Well, if you look at 2 bars in a row and what you get from that, and then you look at what 1 bar gives you when it's all by itself and surrounded by down bars. So look at the difference of what the percent R, the yellow line, is doing when you get back and forth. So here's the low, the down bar, the purple. Start there, right? So here, and then it goes, so here. So it goes this one, and then up. And then see how it's just like sine wave, up, down, up, down? Very, very easy to interpret. Well, now it's not a sine wave. Right now it's making a lower low. And you can see that the percent R made a lower low here. Price made a lower low here, right? But here, what you'll see is if I draw a line on this low, here, on price, you have a lower low, but on oh, it might be really close. I thought it was equal, but it might be like 1 tick low. Oh, it's 1 tick lower. Okay, I'm wrong. Oftentimes it won't be. Oftentimes it will be an equal or higher low at these after these little consolidations, and that gives the opportunity for the trend to take back over again and go and break out. So you can often catch which trap back in trades you want to take, where you get a low and then it closes back inside on 1 bar. If there's divergence on that percent R, or there's divergence on the VZO, like this, either one, honestly, the expectancy like explodes for the trap trades. And then the only issue is, do you have resistance so close to you on the higher time frame that you don't want to take this trade, right? Whereas in this case, my resistance is at 72. And so as long as I feel confident that I can make it to 72, I can take this trade. And like I said, I've got 20 points almost of room and a 10-point risk or so, maybe 11-point risk. And then you can see what the percent R does. It just absolutely goes parabolic and tops out at 0. Okay. Only to reverse. And then you'll see when it goes straight down, what does the percent R do? It goes here, right here. Parabolic down, right? Because this is abnormal. Straight up, straight down is not normal. And then you get sine waves as it goes up, down, right? And then we get to the bottom, and the indicator actually bottoms out at negative 100. It will not go lower. Okay? So here, you can see we couldn't breach the oversold on either one. And here we got to the 0, the negative 100, but this earlier one we didn't. So it's just lower lows, right? So there's nothing to do. There's no indicator. There's no divergence, right? And if it was that close where you can't clearly see it, you can probably just skip it. It's not that good anyway. It needs to be kind of obvious. Now there's divergence. See that? Now this one just bottomed out. So you really wouldn't have a divergent or not, except if you add things like Bollinger Bands or moving averages. So, for instance, oh man, I don't want to. Yeah, my friend Troy, made an indicator on TradingView, but I don't know if it's public or not. But what he calls it is Troy's Willy, and all it is, all it is the William percent R, which is the yellow, and a moving average, the white. So that cross of the Williams percent R over the moving average is something you can use in swing trading. It's just that it's better when you get a retest or a failure to break back down and hold below. So this little pattern here is great for swing trading. And it's another reason I should have held my calls, honestly. I don't know why I didn't. But I just didn't want to deal with a loss during the stream, I guess. But they were clearly good. So this is a powerful indicator as it is, and it's the same thing as the percent R on Sierra chart, except that you have to add a moving average. And so I've added the moving average, the white here, and then I've also added a purple moving average, and that is actually such a long moving average, and it's weighted by volume, that it's only going to move when we get really big volume pushes. Other than that, it's just going to act like a midpoint. So think of the purple like a midpoint, a zero line, okay? And the white one is a moving average that's faster, that's faster, that I can use to confirm or deny a trend. And because of that, I can filter out some entries. So for instance, here, right? Even if this was divergent, let's say that this had clear divergence, but then I saw this and I looked up at the Williams percent R, which is the yellow, and the moving average, which is the white. If I see that the Williams percent R has not breached the moving average, or has breached it but is losing it, so see how here it's breached it, but then when we're not followed by a triangle, it gives it back. You don't want to be long when it looks like this, okay? And remember, we said it looks like this since it's Renko, it always looks like that sine wave pattern when you have down bar, up bar, down bar, or up bar, down bar, up bar. It's when it's alternating in direction is when you get this. So the plane again, or the jet. If you get alternating direction, Williams percent R on a Renko chart, and that alternating direction is occurring orbiting the moving average. And honestly, which one you use, you guys, it's not that important. Just experiment, seriously, or ask Troy if you want. It's I don't think there's anything magical about the numbers of which moving average you use. Just find something that visually looks like it might work, and then work from there. You can always increase it or decrease it. It's going to depend on your style, how fast you are in trading, and all that stuff. So all I'm looking at, though, but like I said, the important part here is to note that when the moving average is flat like this, and you're orbiting the Williams percent R is orbiting the moving average over, under, over, under, over, under, it suggests that this time frame is chopping or balancing. And you really don't want to be taking trades in this condition unless you have higher time frame confirmation of a trend direction. So what this tells me is, taking together with this one, we're going to get to the third one in a minute, because that's actually a time frame in between, which we can use for tweaking, further timing stuff. So here, what we see on the higher time frame, right, was on the TMP algo, we had star triangle down with continuation. We already know that's bearish. Star triangle down with confirmation, all bearish, right? Everything here looks pretty bearish. If you look at the Williams percent R and the moving averages, it broke underneath the moving average here. It orbited back over it, right? So we're probably balancing, because it gave it up and it reclaimed it. Then it gave it up and it reclaimed it. But when it reclaimed it, you can see that the very next bar rejected it. So see how this one, it did touch above it, but it did not make a higher high. See that? It topped out at 0, made a higher low, and then you wouldn't know here, but it looks like it's breaking over it, yet it's not support. And the very next bar gives it up, and it's an aggressive bar, a star, right? Particularly when these are followed by triangles, we already know that that's a bearish signal. But when you look at the Williams percent R, what you're going to see is you also had bearish divergence. See how now again, it tops out at 0, so you may not be able to say that the top here and the top here were divergent, because this one, they're both 0 technically. But if you look at at what's going on with the moving averages, and then if you also look at the dotted lines, which are actually Bollinger Bands, what you're going to see is divergence. You're going to see the Bollinger Bands tightening and dropping, yet the percent R, it's not acting as bullish as it was before. Before it hit zero and price just kept going, and then it's now come back to the zero line and it immediately rejected. Right? So that right there, here, that is divergence on the William percent R, in my opinion. But to be confirmed bearish, we want to print at least one bar, if not two, underneath that moving average. Just to be sure, because at this point I know it's bearish to neutral, but it might still be neutral. And if it's neutral, it could chop around in here for a while. So what I really want is that next one to be bearish. But note on the smaller time frame, here it's 38.88. We talked about this before. At this point, I can already tell if I'm trading this time frame, I was already triggered into a bear here. I was short here. And at this point, I can already tell that we're breaking down. I don't necessarily need the higher time frame to give me that confirmation just to take a trade, but I might want to see that confirmation to know not to buy when it bounces. So, for instance, this tries to bounce. Notice we have not, oh wait, we did. So 71. So by this point, I could say, okay, we not only got a star in the higher time frame, we also got a triangle down that's purple, and we had divergence on the William percent R. We've broken back underneath that moving average. Everything is bearish on the higher time frame, and this smaller time frame broke down. It does not mean to short, but it means this is probably a location that I can short in the future if I get a trade entry on the smaller time frame. So what am I looking for? Specifically star, and what I would love is star triangle down, and I want it to interact with this general price range, right? So, and then, like I said, you could also decide to not buy because you know that they're going to struggle in this area. So you could skip this entire move and just wait until they give up 72 now. So watch. If I skip all this, because I know it's going to be choppy and difficult since I'm trading against the higher time frame, and note the higher time frame continues to make lower highs and lower lows. So there's really no reason to be super bullish anyway. So if I want to skip this entry, for instance, I could. Right? There's no divergence anyway. But if I want to skip that star, I could. And then if I want to skip that, I could. Right? And right there, I'm saving myself like $400, if not more, just knowing not to be long here. Because I've gotten star triangle down, I've gotten divergence in the higher time frame, I've gotten the rejection of the MA on the percent R. Everything looks bearish. And then if you look at the VZO, it's also having trouble staying above zero line. It should be shorts only. Are there short opportunities? Absolutely. You could short this star, you could short this triangle, you could short this star, you could short this triangle, you could short this triangle, and they all work. But what I think really helps is just know not to long. And then once you get back through 72, I knew that that was an area that had sellers here before. So if I didn't short these, in my opinion, if 72 now acts as resistance, I can probably short that star. And then a higher time frame, I could probably short stars up here, like that. Or even closer if possible, like that. Right, we've given up 72. Stars are going to keep working more or less. Star triangle down is going to keep working until I have divergence. And it has to be natural divergence, not hidden divergence, because the trend is bearish. I only want to use hidden divergence with the trend. So if I find hidden divergence to the downside, like a higher, like if I get more room on the indicator, right? So a higher high on the indicator, but a lower high on the, oh no, it's the other way around, isn't it? It's, no, that's right. Higher high on the indicator, lower high on price. That means I have even more room to short, but the hidden divergence on the bull side, I should ignore now because it's bearish. I need natural divergence on the bull side. So I need the indicator to not go down as low, but I need price to continue to make lower lows. If I can get that, I want to stop shorting. Hold on. So here you just keep taking the star, triangle down, until we get one of these to divert, and so to get divergence. So here, lower low, like not, I suppose you could say that the percent R Bollinger Band made a higher low, and we did technically get over the zero line, right? But we did not get over the zero line yet on the VZO, and this is definitely not bullish, right? And and then the MA itself, the white MA, is also making lower lows, which is usually a sign it's not ready yet. So and the yellow just bottomed out, so you don't really know. But what I really want for a trend reversal is actually the VZO. The percent R divergence is primarily for trend continuation. So let me just see if I can find one. So here we had divergence, bullish divergence on VZO. That is okay. And look, it's a star triangle up. That one I can take. Okay. And then it tops out, right? Now, here's a cool thing to do with the Bollinger Bands. By adding the Bollinger Bands to the percent R, and it's actually the Bollinger Bands of the percent R. So it's the same math as Bollinger Bands, but applied to the percent R. And the way Bollinger Bands work is it's looking at standard deviation and saying, what's the likelihood that we would see this much of a move if this was neutral? And what the math of it basically says is when it's trending, what you're going to see, when it's trending bullish, what you're going to see, and this works with price on Bollinger Bands, but it works great with Renko using the percent R. What you will see is as price exponentially approaches or gets over the Bollinger Bands like this, percent R, if it's getting like closer and closer and closer and closer, even if it's not there, but it's almost there, or if it touches it or overcomes it, any of those conditions, it's like this is not close enough. But if it got like so close that you almost can't tell if it's close, if it's touching or not, it's close enough. Otherwise, if it's actually touching, you know that you should wait for divergence before you fight that move. So put very simply, once I see this, not that one, once I see this on the smaller time frame, I know that I can't take shorts anymore, even if they set up on the smaller time frame, unless I have natural bearish divergence, preferably on the VZO. But technically, sometimes it shows up on the percent R first. Usually it shows up on the VZO. And in addition, if the higher time frame aligns, I can take bullish trades with the trend on natural or hidden divergence. So any difference in higher low or lower low between the indicators and price, as long as it's on the lows, as long as the divergence is on the lows, I can take the trade because it's bullish on this time frame is what that means. By the time it's touched that upper Bollinger Band, particularly when it's expanding. See how the Bollinger Bands are expanding? I forgot to mention that. The Bollinger Bands need to be expanding to expect an extension. And that's the other nice thing is you can watch actually like as it kind of squeezes in here. This occurs before consolidation, but you can see that price continued to drop. So it's saying, again, since it's not, if you don't know what Bollinger Bands are, how they work, just look it up. But because it's looking at percent R, so it's comparing like how many bars closed bullish versus bearish, not just price. Because it's the Renko, it's looking at did it close bullish or did it close bearish, and then how far did it go from the high to the low. So how big were the bars? In other words, is what it's looking at. And what you're seeing is that the size of the bars and the amount of bearish energy, let's just say, is slowing down because we're now from here. It starts the bear starts here. Okay, when on this time frame, it starts here when you cross that moving average. and the zero line, basically the purple line. Once it's crossed underneath there, you know that it's probably bearish. Plus, you can see how the Bollinger Bands from way back here started to tighten. See how this starts to rise and this isn't rising anymore? That already is a sign that like bears are kind of like losing steam and we should expect some sort of a pullback. And then you actually get confirmation that the pullback is occurring. And at this moment, it touches the Bollinger Band. See that? And it bottoms out. So now what I want to get long is divergence, bullish divergence only. I get it on the VZO, which is perfect, right? Lower high, or lower low, sorry, I gotta get that right. Lower low on price, higher low on the indicator. And now I know that I've touched, like I said, even though I've touched the lower Bollinger Band, because I've gotten this divergence, I can fight that trend because there's a chance that this is the reversal, particularly when the higher time frame is in position. And in position below that blue channel and preferably not touching the midpoint. If it's touching the midpoint, it might just be like a really big bar. But as long as it's not touching the midpoint and it's touching or lower than that lower channel, it's okay to start looking for longs. Okay, but we need that divergence to be there. We need to see this divergence to consider taking a long. And then we need it to actually set up on the algo. And then, like I said, if it's trend day down on this time frame, you may want to wait for the divergence and then see if that low can hold. And then you can take the next aggressive setup to the upside. But like, the important part is that once this indicator bottoms out or touches the Bollinger Band or gets really close to touching the Bollinger Band, you really don't want to fight that trend. And the only I've got the divergence here. I'm at the right location, but I've got, if you recall, I've got sellers in my way. See the star here? That's going to create resistance. So, and then it's even more obvious on the higher time frame. So this is, I guess I'll bring this in now. So on the right over here, I've got it's the 30 tick. So here it's 15, here it's 67, and here this is, 40 tick. All the same rules still apply. So for instance, let me just erase all these lines. We talked about when it's bearish, what you usually see is star at the most. 38, let's say. By 38, 88, 33, 88. So right here, we knew that 40 tick was bearish right here. It's like the 40 tick said, do not buy anymore. You're either bearish or neutral. And so the sells might work, but the buys probably won't. You actually knew once this, I think it's this one, when I think it breached here. That's the triangle down. So you know quite with strong certainty, not here, but here, by the time that wick came in, it printed this purple bar being a triangle. And now you know, okay, I don't want to take these longs unless I have divergence. Now look, and it's got to be natural divergence. Otherwise, I can take sells as long as there is some divergence, but it can also be hidden divergence. So take a look here. No divergence, right? Is it at the right location? No, it's in the middle of the bar on the bigger times, right? Middle. It's not the right location to buy. If anything, it's the right location to sell. It's not a good place to buy. So wait. You do get star triangle up. It's just the higher location. You're up here. You're at 01, so you're up here, and this 40 tick. You're near the middle. There's really nothing to do here. Not on the higher time frames. Even though this is technically bullish on this time frame, it's probably not going to go anywhere. It goes up like 3 ticks and then turns. Now, what do you get here? You get star down. Whoops. Star down. After getting confirmation here that you had star triangle down, you now get star down. Actually, triangle up, star down. Okay? That alone is good enough. if I had divergence on any of these indicators to the bear side, it'd be even better. But at the highs, but I don't. You can see that it's all lower highs and lower lows. So there's just nothing to do here other than sell. There's no change, right? It's just bearish. So you can sell that. And then here, same thing, right? Not divergent to the bull side. It's making lower lows, right? So don't buy. Here we're not at location. There's no reason to buy that one, even though it's a star. It doesn't even get a triangle up. Can I sell this X with a dot? Usually that's a pretty good move as long as it's going in the right direction and my location's okay. Do I have any buyers underneath me? Not really, right? Is there any bullish divergence I'm fighting against? Not yet, right? Possibly if we get an up bar. If we get another up bar, there might be here. But this one, not yet, right? We have not gotten an up bar after this move. So if we got an up bar, it'd be trouble to be long. But as long as you don't get an up bar, it's okay. And so if you want to short, and this one was an up bar, it would give you divergence here, and you'd be out. But here, that's not an up bar, so you could stay short. And then now it's clearly not divergent because you've made a lower low on price and the indicator, and so you'd hold your short and get paid, right? And then note here, now we are in the location that I would expect longs to start to show up on that time frame. But do I have divergence? I don't. It's lower lows and bottoms. All the indicators and price is making lower lows. So the 40 tick is not divergent. It's there's no reason since we last approached the so here we approached the Bollinger Band, so that's pretty bullish. And then you can see we broke above the zero line on the MA, broke above the zero line. The percent R couldn't break the zero line. We went back and topped out, couldn't break the zero line, hit the EMA, and then broke the zero line. And you can see that the EMA is also tilting down, and it's probably going to break the zero line again. Is it bullish? No. No. So even if it gives me a star up here on the 15 tick, I'm not going to take it. Right? So like that, I'm not even going to worry about it because all the higher time frames tell me, even though I'm at a location that they might try to buy it, it's probably not going to work. The only issue is if you look and say, well, where are the sellers? Well, the sellers are pretty far away now. So even if they could get a retrace back to 72, no trouble, right? So you'd have to be able to hold it while it pulled back. But as long as you can leave your stop up here, it's not really at risk of getting stopped out. You can see down here where they still have not gotten over the zero line. And they are now potentially going to make hidden bearish divergence because they're going to make a high that's higher than this high. And as long as this high here doesn't break, it's bearish divergence. So right here, they push a little higher. You can see that this second high is just slightly higher, perhaps, or equal to that earlier high. But this high is clearly lower, right? That is bearish divergence, and you can actually short that in the hole. Okay? That is, in my opinion, I can short this. I know it looks freaking scary because you're at the low, right into the rejected. See that? Higher high. Couldn't make it to the zero line. Turned around. Look at William percent R. It's bottomed out. It tried to come over it, and now it's coming back into the EMA. As long as it gives up that EMA, we are good. So if you want to wait for the triangle to be sure, now the EMA is under, or we are under the EMA, and it's going lower. And now note, the William percent R has flatlined. It cannot go lower than negative 100, but the Bollinger Bands and the EMA can, which is interesting. So it'll continue lower, and you don't really have to even watch this indicator anymore until you could just be short until the VZO can either produce bullish divergence or it produces a big enough rip where it makes a higher high, and then you might get another entry. Or be looking for a divergent low in the future. So look, we get a big rip, right? Am I buying that? No, it's not divergent. We've got, this had bottomed out, right? The only way I'm buying this is if the higher time frame is divergent, and it's not. So even though the higher time frame set up here, it's not divergent. And if you see the percent R clearly touched or approached the lower Bollinger Band, so I can't buy, I can't take a reversal until I have some sort of divergence. So I'm going to need another lower low before I can buy on this time frame, the bigger time frame. So can I buy this? I shouldn't, right? You can see what this does though. It takes it from the like depths of 0 and it breaks all the way over the Bollinger Band. And so right there when it breaks over the Bollinger Band, oh, hold on. Once it breaks over the Bollinger Band, the condition shifts on this time frame. On this time frame, it says, wait, don't short until you get divergence, right? So this is what keeps you from shorting in the hole, in my opinion. This is what protects me to know that when it turns around here sometimes, I can't short it now because it's already touched the upper Bollinger Bands. I still shouldn't really buy it unless there's divergence here, and I don't think there is. But the next low, if it's divergence, I could buy. And I might miss the low, but the important thing is don't sell this because it's already beat the Bollinger Bands, right? So I'm not looking to sell this. That's very important. Do I miss it? Yes. Is that location for a long? Yeah. I'm going to skip it because I did not have divergence and I don't have a clear way to filter out this here from this without the divergence. So I end up missing a move, which is fine in my opinion because there'll be pullbacks, right? So now, am I going to short that? It's a star only if there's bearish hidden natural divergence. There's hidden divergence. We made a higher high on the indicator and a lower high on price, right? But we had touched the top of the Bollinger Band on that same time frame. So I'm not looking for hidden divergence. I'm only looking for natural divergence. And here I don't have it. So this short gets skipped. Okay? And again, these both work, right? Which is cool. But I'm going to skip them because sometimes they won't. Now what you'll see happen is we get a low and then a lower low and we get a low and then a higher low. This is the buy I want. Okay, that's the one I can take. So did I skip this and this? Yes, but now I can buy this one with confidence. I'm still at the right location on the highest time frame, right? Now, does this one stop? It might stop. Oh, it never made it over the 0 line. I was wrong. So look, I forgot one step. This is, like I said, it's complicated. I made the same mistake earlier. This looks good, except that we've not yet broken over the 0 line on either of the indicators. It's not bullish yet. It's if you've been dealing with heavy trend down, it's not ready yet. If you were coming out of neutral, it's enough to buy. If it's coming out of heavy trend down, you need to wait for the 0 line on at least one of these to break. And as you can see, we break it here on the percent R, but it's not. It's contracting. See that? It's contracting. So it's really not bullish yet. We need this to also break over, or we need to get something like this to happen with the Bollinger Bands, like a squeeze. If this was here, it'd be fine. If it looked like this right here, it'd be good. But this, with it so far apart, it's too risky. And like I said, it's real obvious here that volume is just not following through. So I made, and it never does break it. So I'm still not looking for pullbacks unless I get divergence. So I'm not buying a trap here. If this traps back in right here, I'm not buying it. Like that, I'm not buying that either. Right? It's technically valid, but I don't have natural divergence on the VZO. It's got making a lower low, and the percent R has bottomed out again, and I'm not pushing up against the Bollinger Band, so it's not bullish, right? And it just reverses. Now, should I take this short? In my opinion, no. This is shorting in the hole because I've already. Well, let me see here. Am I wrong about that? Maybe I can. Do I have divergence? I have divergence. Did I touch the upper or lower Bollinger Bands most recently? I touched the lower. I can take that trade. So had I not touched, I didn't see this. This got close to or touched the lower Bollinger Band, which means that I can still short the hidden divergence to the downside. Whereas back here, when it touched the upper right here, I can't take this one, even though I realize it like turned out better, but I can't take that short. But I can take this one It's crossed below the zero line or below the EMA. It's broken below. It's made a divergent high, a hidden divergent, and it's bearish, and it's a bearish entry. So that's okay. And that one might actually stop. This though is a buy. See how it made a higher low? So even if I was short here, I'd have to flip here because this is clearly bullish divergence. It's a star. The location is correct. It's down here. I know this shows it at 33, but we're not at 33. We're down at 07. So we're down here. The location's right. It's at the bottom of the channel, right? Oops, can't see this one. The location's correct. And, sorry, I didn't mean to show all that. So if you got in here, which like I said, I think it's okay. You just have to, you'd have to cover it, break even when that prints and flip long because of this divergence here. Technically, this is also head or shoulder, head, shoulder. So if you get used to knowing what these look like, you might not want to short this if you see that it could be a head and shoulders on the indicator. And then plus the percent R bottomed out and it didn't, if it spends less time under at the bottom, it's probably losing momentum. So here, see, if you count the bars, so it hit 100, negative 100 here. So 1, 2, and then it came back up, right? 2 bars. I guess it's 3 if you count this one. 1, 2, 3. Right? Here it hit negative 100. Here, 1, 2, 3, right? And then it comes back up, right? Now it hit negative 100 here. So 1, 2, and then we don't get any further. So with only 2 bars at the bottom, at the what's it called? Like flatlining, you can kind of see it here. See how it's like long period, short period, right? Even though it doesn't go any lower than negative 100, it's the same basic concept as divergence. It's losing momentum. It's not gaining momentum. It needs to be pushing harder to go lower. And both of these indicators suggest that it's not pushing harder. And like I said, because this one's actually divergent, I can buy this. So that's a buy. And then you can see right here, it approaches or touches the upper Bollinger Bands, telling me that if there's a short setup, I don't want to take it unless I get natural divergence. So like here, even though it's a higher high, and if it turned bearish here before it touched this high, I still don't want to short it because we've already pushed up into the top of the Bollinger Band. So you stay long is the way you're supposed to do it. Then you can see we topped out the percent R, right? And then we came back down. So, and then Bollinger Bands tightening, coming back into the zero line. This is falling out of overbought. Can I short it? Technically not, because the last time I touched a Bollinger Band, it was the higher one, right? So I'm skipping that. Doesn't mean it can't work. It's just oftentimes you're better off waiting for a long instead. What would a long look like? It would be a lower low on the indicator, followed by an order flow signal, or with a higher low on price, or a lower low on price with a higher low on the indicator. So either one of those situations would be fine. So here there's really nothing to do here. So you just wait. It's going to chop around, orbit the EMA, and then right here it made hidden bullish divergence. See that? Lower low on the indicator, higher low on price. So that here, that dot with the diamond is probably a buy. There you go. Now we made a higher low or higher high, right? And we topped out here, so that counts as a higher high. We're not bearish, right? And this low, we're now making lower lows on the indicators. So if this low holds, we can buy it again. So let's see if it holds. It does. See how it holds there? Right? So this is a lower low, but it's not breaking the zero. This is a lower low, but this is an equal or higher low. It's buy. Right? Bullish. As long as it stays in the green, basically, it's bullish. More or less. And then we're watching. Now, look. It hit when it went down, it hit or approached the Bollinger Bands. So if you want to be conservative, you could skip this one since it's hidden divergence, right? But all I have to do is look at the higher time frame, and I can see that we've already performed the reversal here, right? And I can tell it's bullish on both of these time frames. So I don't need to be super cautious. But if I wanted to, I could be cautious here and stop buying it. But then as soon as we approach the Bollinger Band on any other time frame, like so right here, I know I'm bearish or bullish only now. Right? So on the higher time frame, I'm bullish. On the smaller time frame, we have not touched the lower Bollinger Bands. Right? So it's, I guess right here you tag it, but you haven't run against it. Now you come down and run against it, right? So I might want to wait for divergence again before I buy. And so this one, I guess I could skip if I decided that's not divergent. And then I missed that, but at least I wouldn't be short. And then it tops out again. Nope, this is clearly bullish in the higher time frames, right? Okay. Tops out. It's now coming back down through the EMA. This is coming out of oversold. Nope. Not letting it go, right? Okay, almost. Coming out of oversold. There. Out of oversold now. Out of overbought, I mean. But look, we need to make a lower low on price. Otherwise, it's going to be divergent. Nope. No lower low on price. See, that's higher low on price. And so it's going to try to go higher. But again, we touched these lower Bollinger Bands, so we might not want to buy it. Like you might be buying at the top, but you don't want to sell it yet, right? But here we got divergence. See the divergence, bearish divergence right here. That would be our first opportunity to sell. I just want to get it back into the green. So that is probably okay, but we need to break this low, otherwise it's hidden divergence. There, that's definitely bearish on this time frame. See that? What happened on the higher time frame? We approached the higher channel, which should be our target, and we're now reversing. What happened here? We hit the target and it's trying to reverse. All those things say it might be bearish. So that, and then like I said, the hidden divergence, natural divergence on both indicators right here, and then the lower high on both indicators. All of that says more bearish than bullish on this time frame. Where is it going to take us? Probably back to support or the midpoint of support on one of the higher time frames. So it keeps going. You can see there's no bullish divergence here, and we've hit the lower Bollinger Bands, so we don't really want to be just randomly buying dips, right? Okay, so this one did not set up short because, yeah, it just didn't set up short, and that's fine, but this one did. So it's probably a short-lived bearish move because the higher time frame did not trigger short, but this one did. So now we're looking for divergence on either time frame. We don't have it yet, right? We need a lower low here. This one might be time-based divergence. I'd have to count, see how many bars we got. But what I really want is a lower low on price. And I don't know if it sometimes it won't show up. So do I want to short this? No, because I've touched the top Bollinger Band. So I would need divergence to short it. And I might have it there on, I might have it here on %R. But then it immediately, then it has to break this low. Break the low, break the low. Yeah, that's going to drop back in. So that one's probably better. I can't tell if it's divergent or not, and that's usually a good reason to wait. If you're not sure if it's divergent, it's not divergent enough. So see how they keep pumping it? They can't get it below the zero line. It's just not weak enough to turn over. And not surprisingly, they just consolidate and lift. And that's the risk of using a smaller time frame, is if you try to make decisions based on this, you're going to miss bigger trades. But on the higher time frame, you can see it was clearly bullish, right? We're just waiting for an entry signal, which happens technically here. This one is pretty good. And that might be hidden divergence here. Lower low, equal low. So if you again, the best way to do this, identify direction, then zoom in and find your trade. But again, on the highest time frame, it's bearish, right? Triangle down. So you could just skip all of this. Skip. Wait for 72 and take this short, right? Especially if you can get divergence on a higher time frame. I don't know if you will. Let's see if you do. Right there. right there. Higher high, lower high. Maybe not. Maybe not. It's close. That one might be too close. See if we can get it. I mean, these all set up if you knew what to. If you go with Simon's method of just you know it's bearish here and you can start taking stars on pullbacks, you're good. As long as they set up in the right spot at the top of as long as they're not touching the midpoint. So that's Simon's entry, and it's beautiful, right? That alone is so great. But if you don't have that, or you don't understand it, or whatever, you can look for these divergences and still do pretty well. Let's see. But again, you'll miss a lot without those. I'll be honest. You would miss a lot. But I'm just trying to find some more spots where this sets up. Okay, here's see how it's bearish? It's staying in the red, right? And it makes a higher high on the VZO, but a lower high on price. Even though you're so deep in the hole here, you can probably still short it. On the higher time frame, it's clearly bearish. Yes, you did tag the upper one here, so maybe that rule is just a little bit too strict. If all of everything else is combined, if there's confluence, you just have to be quick about it. So I would expect one burst lower. Oh, this one goes for days. So yeah, that's pretty cool. So here's bullish divergence. See this? Low, higher low. But we have to break over the zero line before I'm going to trust it because it's been so dang bearish. So we break over here. Now I'm looking for pullbacks to buy. Okay. But I want like some sort of divergence, something more. Whoops. So low, higher low, that's your entry, right? We've already done it once and held it. We now trap back in with the divergent low. That's the good end. This is the very aggressive scalp. This is the very conservative trap back in, right? And now that it's lifted and gotten continuation, maybe I should just look at the 40 tick because look, once this approaches the Bollinger Band up, I don't want to be selling anymore. And had I thought about that, I wouldn't have sold my calls so early because I sold those like 340. I sold them here, and I thought it was a great trade, right? It just kept going. It just kept going and going and going, right? And that's that's how it's going to be. But again, you would have had to hold through some pretty nasty chop. And in here, though, you do have opportunities. If you identify that you're bullish, star, triangle up, right? Triangle up. The ring triangle up is good also. And you're approaching or touching the upper Bollinger Band on the higher time frame. You know you don't want to be short. So now I just need a lower low on the indicator, but a higher low on price and a sign of aggression. So higher or equal lows on the indicator, right here, right? Equal low, maybe equal low, but higher low goes higher. Am I going to short that star? No, there's no divergence. There's no reason to do it. All the higher time, even though I'm at location, the higher time frame says super bullish. All of the momentum indicators are pointing up and to the right. I don't want to touch that. I don't want to fight it. And look what it does. It pulls back. It makes a lower low on the indicator, but a higher low in price. See that? Lower low. Now, as long as I get up above zero, I'm good. Buy. Right? Lower low on the indicator. Higher low on price. Purple bar, diversion bar, probably bullish. Right? So you could just keep doing it and like literally just destroy shit. Like just fuck shit up. As long as you know the direction. And again, where I have trouble is I see my location and I immediately think about what might happen next rather than waiting for confirmation. And just forcing myself to wait for that natural divergence before I can even think about reversing is going to help me a ton. It did today. Because see, all of this, none of this is difficult to analyze if you know you need the divergence. So here's your first divergence right here. That'll be your very first try where you might want to short, right? And you'd get probably 8 or 9 points, and then it would immediately go against you, and you'd be like, nope, I'm wrong, right? And it doesn't set up again. So it's not that they're all at work, it's just that it limits it. This one looks like it could be divergent. You need to get under the zero line. You don't. Just go the inverse, right? Because it's trying to set up bearish and it just can't do it. Go long, right? Same thing here. Lower low on the indicator, higher low on the indicator. It's going to go higher, right? Until you get divergence. This one's a nice high. If we get a higher high than that, that's divergence. It could finally move. Nope. See how it just keeps going higher? So instead, lower low on the indicator, higher low on price, pink, just take it. I just need to be confident that trend day up will just keep going up until there's divergence. Here's the first sign of divergence right here. High, higher high. Now is there a divergent high, right? That's the first one. So now if it's been super bullish, right? So now I want it to drop underneath the zero line. I don't want to be the first mouse. I want to be the second mouse. So drop under the zero line doesn't happen. Does happen. That triangle there would be the very, very aggressive way to do it. Otherwise, wait for a trap back in or something else. But note, we did get already the percent R to touch the lower or approach the lower. So you know to stop buying, right? Do you miss a little scalp? Do you miss this? Like, good, right? Like, I'm glad I missed that to the upside. I don't want to buy that. I don't want to buy that. That, in my opinion, is the kind of shit. When I buy this stuff, that's the kind of stuff that makes me tilt. So I need a way to protect myself from that if I'm going to go buy this and this and this and this and this. I need a way to not buy every time it does this, even if it means I don't get this one. I'm okay not getting this one. I'm okay not getting this one as long as I get this one right on the first or second try. Now look, slight divergence, it's probably going to get a decent pullback, right? It tries. Now, which direction are we going? Well, look at the higher time frame. We got a star above the channel on the 67 tick. It doesn't mean it has to go to the bottom, but it definitely could, right? So you should be prepared for that. Have we had divergence to the upside? Yes. So it can be bearish, particularly stars and triangle down. So stars and triangle down. On the higher time frame, if you think about it this way, on the higher time frame, that star is one big seller. And that big seller, you can just think about it that way. That big seller is sitting right here. So that is where you end up getting stuck, is the open of that star bar. So technically, this divergence did exactly what I would expect it to do. It brought price to resistance. The problem is resistance was 5 points away. Once it rejects off resistance, is bullish, and the indicator makes a higher low, I would need price to make I guess it's okay since this one was divergent, this one's a higher low. Now I can start taking trades. But I need to be aware that the higher time frame says it might turn around anytime and go bearish, right? But this time frame, the in-between time frame, it's had the triangle down, and it's touched the lower Bollinger Bands, right? So like it also makes some sense that we might get at least some sideways, if not bearish action. You just don't know how long that's going to go. It's going to depend on whether or not we get this triangle. Once this triangle prints, the likelihood we're at least coming to the midpoint is really high. And then you definitely don't want to be buying these little bounces. And if you want to be safe, just stop buying once you see this. Just quit it. And yeah, you'll miss a couple big 40-point moves, but you'll also miss a ton of stops. And instead, once you see that, wait for the triangle down, and then pullbacks can be sold, particularly if there's divergence. So that's a good 2-hour explanation of something it's a little complicated, I know, but if you get it right, it works great. And I'm going to keep hammering away at it, and I will share more setups so people can see how they work. But I'm watching this like hawk for these divergences to filter out the which trades I want to take and which ones I don't. And like I said, today it worked beautifully. So we'll see if that continues. I probably should have just kept it continued to work even after I got out. So Yeah, this seems to work for trend and for balance. So, highly recommend you guys check it out if you want to learn more about the algo, because honestly, it makes life so much easier. It improved my trading within just a matter of months, honestly. But I would definitely recommend. Oh, let's see. I'm not. Why aren't we seeing the faux banner? Is not working. Okay, well, it's